What's going on, everybody? My name is Matthew, and today we are talking about one of my most recent stock picks that might just be the next Wall Street Bets crusade. Let's do it. Now, I didn't expect this to become a meme stock, and in fact, I thought this was actually pretty under the radar, but right around when I released the video, Bed Bath & Beyond, ticker BBBY, started to get on a lot of people's minds for several reasons. For me, it was a compelling turnaround play that I thought looked just ugly and unappealing enough to have some serious value. It's kind of like if you've ever gone to Hawaii and you do that thing where you pick an oyster and they say to pick the ugliest one to get the best pearls. Well, Mark Tritton and his new management team and their turnaround plan is that pearl to me. I don't know, but I'm boring. Wall Street Bets likes it because it happens to have an insane short interest that can create a short squeeze. And we all know what they did with GameStop. They're hoping they can do the same with BBBY. But enough about that. I am not investing based on any short squeeze or on any Wall Street Bets speculation. Instead, I'm here to update you on their fundamentals after their last earnings report. Give me the format. First, some pretty great updated numbers from their last earnings report on January 7th. Second, what we can expect moving forward with BBBY and their other brands that they still own. And finally, third, what am I going to do now that it's run nearly 50% at one point since I bought in? No time wasted. Part 1, their Q3 earnings. I will say I got a decent amount of shade after it dropped the day of their earnings report, and that wasn't too much fun. But this was always a long-term investment, as I stated many times. Soon after, Mr. Market realized that their numbers were actually pretty promising, and obviously we've done well with this position so far. Anyways, right off the bat, we can see they saw a 5% increase in Bed Bath & Beyond banner comparable sales growth, which is revenue just from their Bed Bath & Beyond brand, not Bye Bye Baby or Harmon. This sounds small, but it's actually incredible because historically, their same-store sales have been negative for years, and Tritton and his team have come in and already started reversing this trend. We also saw a 94% increase in comparable digital sales for their Bed Bath & Beyond banner. Again, more proof that their e-commerce transition is working. We saw incredible improvements in profitability with their adjusted gross margin jumping by 310 basis points or 3.1%. This was a jump from 32.3% to 35.4% gross margin year over year, leading to a 168% increase in adjusted EBITDA year over year as well. And I want to break down this gross margin increase because it really highlights and visualizes how their plan is working. On the left, we have the baseline gross margin from Q3 of 2019. 1.8% of the gross margin increase is from promotions, markdowns, and coupon management. The team said they'd make prices so competitive that you wouldn't need a coupon, and it's working. The next 1.2% came from their product mix, which I assume means reductions in their inventory and the number of vendors. In fact, by cutting down on the number of vendors and brands they carry, Bed Bath & Beyond could deliver 200 to 250 million in savings over the next 3 years. And they've already secured 100 million in savings after addressing 60 vendors. And they plan to address nearly 500 vendors by the end of year 3. The next 2.1% comes from leveraging their distribution and fulfillment costs, such as their strategic locations of their stores. And there's a loss of 2% on this gross margin because of the increased shipping costs with the e-commerce transition. So this graphic really shows their plan visualized and in action once again. For some more on their e-commerce transition, they saw 2.2 million new digital customers with an increase of 25% on their online conversion rate, which is actually very significant. And that is because right now, 35% of baskets have one item or one category, 36% of customers can't find what they want, and this is in-store, and 41% abandon digital carts. And this isn't great, but it sets up Bed Bath & Beyond for huge growth potential. They project that each 1% increase will lead to another $25 to $50 million for BBBY. And that is why that increase in online conversion rate is so crucial. Now, continuing with financials, after ending their last quarter, they produced $244 million in cash flow, paid down $500 million in debt, and ended with $2.2 billion in liquidity, $1.5 billion of that being in cash. Here it is on the balance sheet. You can see cash at 1.46 billion, and I also want to point out how inventory is significantly lower compared to February of 2020, which means a decrease in expenses like carrying costs, and this is probably a result of better vendor selection and closing down unnecessary and non-core assets. Signs of management execution are popping up everywhere with this stock. And so far, the executive team is sticking to their financial plan as well, allocating capital accordingly. They're investing in growth and transformation in their e-commerce transition, which we already touched upon, development of their own brands, which will hopefully increase their gross margins even further, improvements to their supply chain and their customer experience, and much more. They're paying down debts to ensure financial stability and resiliency, and they're also, again, returning cash to shareholders through share buyback and repurchase programs. And speaking of which, while maintaining a strong cash position, they bumped the share repurchase program up to $825 million from $675 million, with a portion of their accelerated share repurchase program, $375 million worth, expected to be completed by the end of Q4, or February 27th, 2021. This will likely place even more pressure on the short sellers, considering the market cap of the BBB is only $3.1 billion as I record. Alright, now for part 2, what can we expect from the BBB moving forward and from their other brands? Well, the first thing we can almost certainly count on, the one thing we can all probably take to the bank, is that they were smashing that like button for the YouTube algorithm. Did I get you? But in all seriousness, these videos do take a long time to research, record, and edit, so I'd really appreciate it if you just smash that like button down below. Thank you so much. Okay, but really, what can we expect moving forward? Now that they've completed their portfolio transformation of selling their non-core assets and their cash has reached their balance sheets, we have a much better idea of what to expect financially. Expect $8 to $8.2 billion in revenue, a gross margin of roughly 35%, which we already saw them achieve, and EBITDA of $500 to $525 million versus their pro forma 2019 fiscal year estimate of $425 million. In terms of their actual stores, the future of their stores, and the current store remodels, as mentioned in my first video about BBBY, they launched a new test store in New Jersey, which was a complete reimagination of their store and shopping experience. Now, after receiving data and feedback on their store, they're now moving their new look to the Houston market as they begin to scale this massive brand remodel, and they will continue to learn as they scale. It'll be really interesting to see just how much these complete remodels can drive sales and increase those in-store conversion rates that we talked about earlier. Additionally, in regards to buybuy BABY, another one of their main brands, they actually plan to double this business over the next 5 years. One growth driver, for example, will be innovation, with programs like 3D shopping, where you can actually build your ideal nursery online and switch different products in and out of this 3D render. Pretty cool. Another huge opportunity, and probably the more main and reasonable growth driver, is to expand their customer lifetime value by offering products applicable to toddlers and kids and staying with these customers beyond just the baby stages. And yes, 75% of customers say they'd continue to buy from buybuy BABY through school ages. Management expects a $250 million at least into the buybuy BABY brand because a lot of what they're working with there is kind of outdated. Now, when I hear outdated, I hear leaps of improvements for that company. So there's still a lot to be done with this turnaround, but I'd say we're pretty much done with maybe phase 1, where we strip down the business to its bones and get ready to rebuild. With that being said, let's get into part 3. What am I going to do? I didn't end up getting to fill my entire position on this stock, so I'm probably not going to average up here either. A large reason for that is because obviously there's a huge short presence in this stock. And personally, I haven't experienced or held too many stocks that have this much short interest. Therefore, I'm not 100% sure, to be completely transparent with you, how to decipher the price action. Is it a fundamental move based on some really good numbers, or is it just shorts covering, or is it a combination of both? I can't really tell. I came into this with a price target of around $30 to maybe even $40 at the highest level, and if it does hit that after a short squeeze, I'm probably going to be selling my position for 1, because I didn't get to build it out completely, and 2, because even though it's a long-term investment, I came in here fully prepared to own it for 1 to 3 years, but if that price target gets filled in a matter of weeks or months rather than years, I will take that all day. It just becomes a long-term investment that was realized in a shorter period of time. If it's a result of the short squeeze and not fundamentals, how long will it take for fundamentals to catch up to this new price? And that right there could become opportunity cost, which is just as expensive as losing money. I'm also willing to sell this stock here because I have several high growth companies on my horizon that I would like to enter and add to the public portfolio. In fact, I've actually already bought one or two new companies, so make sure you subscribe to get those videos, full thesis coming soon. But one of my criteria for selling a stock is I should know where that money is going to go. And finally, it wouldn't really make sense to scale out of a position like this for me because I never built it out fully in the first place. If you have a full position in Bed Bath & Beyond, maybe it's worth scaling out of instead of selling it all at once, or maybe even setting a trailing stop loss or something like that. And as always, these videos are a stream of consciousness. They kind of reflect my thoughts right now. They're always subject to change, but this is what I'm thinking as I'm recording this video. So to sum this all up, ideal situation, the fundamentals make shorts realize that, oh, I should not be shorting this stock because they're in a serious turnaround. The price goes up to maybe $36, we double our money, we exit this position, we put that money into one of the new growth stocks that I'm currently investing in and looking at, and then our portfolio stays at the kind of level of diversity it's at right now without having to add way too many stocks. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out our quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.